Welcome, everybody, to our next web conference. We're glad that you're here. It's a sunshiny day in Augusta, Georgia, and we've had back-to-back up days in the markets. So I think we're all probably feeling a little bit better. I hope you are. We wish you health, and we hope that you're taking care of yourself during these crazy days. Just to reiterate a couple things that we talked about last week, don't be obsessed with the markets, even on a good day. We talked about not looking last week, and we still think that's a good idea. Either at the financial news or the world news, don't bury your head in the sand, certainly. But looking at the financials 3 or 4 times a day are not going to lead to better investment decisions. Get outside, exercise, take care of yourself. We've been offered some simplicity in our lives, and it's kind of nice in some ways, so enjoy it. Today I'm joined by Clayton Quamme and Sharon Head in our office. They're going to help and participate. After last week's meeting, I knew I needed some help, so we're happy to have them here. And I want to take this opportunity to thank our team. We have got a great group of folks here, and during these turbulent times, I'm proud to work with them. And I know they've got my back and mine theirs, and they're doing everything that they can to help everybody here and all of our clients and future clients. And I'm happy to be with them, and I'm very pleased. We want to take your questions as usual, so I'm going to turn it over to Sharon. And Sharon, would you please tell our audience how they can ask questions today?
Sure. Thank you, Gene. There are 2 ways you can ask questions. If you were on the Zoom meeting last week, you can go to the chat box and enter your questions there. And we'll take those and try to be a little more interactive instead of just waiting to the end. Or you can go to the participant screen. So you'll need to find your Zoom toolbar that may be at the bottom of your screen or could be at the top depending on the device you're on. And if you select Manage Participants, you'll see a place where it says Raise Hand. And you would want to use that to raise your hand. So that's pretty much how you can communicate, and you can send me messages if there's any problems or call our office. Thank you.
Thank you, Sharon. Just a quick market update. We've seen, as I mentioned, 2 up days, large gains yesterday, and then some black today, which is good. We're likely not done with volatility. We're still not certain as to what's going to happen with this coronavirus, when we're going to see a peak, how we're going to deal with it. So with uncertainty comes volatility. Also tomorrow, unemployment numbers will come out. Those are probably going to be frighteningly poor. That's something that we're going to watch really closely. But the other thing that happened that drove yesterday was our Congress injected liquidity into the market. And a great parallel for that is oil for the car. Certainty comes with liquidity, i.e. cash on hand for businesses, for banks, for individuals. And so liquidity was a big deal and certainly helped. We'll pay attention to tomorrow's unemployment numbers and probably begin to think about deploying capital based on how the market reacts to that. We'll talk more about that, but we're going to be slow and deliberate, just like we've always been. History tells us that dollar cost averaging and not timing the market is how we need to proceed. We've had some questions about refinancing mortgages, so I'm going to call on Clayton to update us on the mortgage refinancing environment before we get started. And y'all be patient with Clayton. This is his first bear market. Clayton?
All right, guys, I think I'm muted now. Thank you, Gene. I appreciate that. And it is my first bear market. I was graduating when 2008 hit, and so I was super excited at that time to be pumping the little bit of money I had into the market. That's been great the last 12 years, but now I get to experience the market with a little more skin in the game. And it certainly is an emotional period when you're looking at your own accounts. But as Gene mentioned, the best thing you can do is just be patient, and honestly, it truly is not to look. So get to the refinancing discussion. There's been a ton of refinancing opportunities out there. The rates have dropped significantly, and so a lot of us around the office actually have taken the time to reach out to our own lenders and other folks in the area just to shop the market for refinancing. And myself and Pat Fair and even Tom, and I know Sharon too, have all talked to current lenders. Pat and myself have pulled the trigger. So we've each locked in rates on 15-year mortgages that are going to end up saving us a good bit of money and moving forward. And I think the thing to think about when you're thinking about your own situation and the loans that you have and the debt that you're maybe wanting to consolidate or do something with is, if your current rate is 0.75% higher than what the rates are today, it's definitely worth talking to folks about options out there and talking to a couple of different lenders and trying to shop the market. What we have found is the 15-year mortgage rate is bouncing quite a bit. It's quite volatile, but it generally has been in the range of 2.7 to 3.25. And if you're patient, it seems like it kind of comes down to 2.7, and then it might go back up depending on the day. But when Pat and I locked in rates, we caught it on days when it had gone back down to around the 2.7, 2.75 mark on the 15-year mortgage rate. So I think that would kind of be the main update on the refinancing. If you think it's something that you want to look at or should be looking at, please don't hesitate to reach out. We've had a number of clients email or call us, and we've been able to talk through their situation specifically, and then also connect them with folks if their current lenders don't have terms that look real good or rates that look real good. We've got folks that we can connect you with that we've found success with. So with that, I'll turn it back over to Gene.
Thank you, Clayton. Good job. We have clients and future clients tuned in today. There'll be recordings of this virtual briefing available for you to review and to share with others who might benefit from this information. We hope that you'll share it. We're going to discuss 3 strategies today during this down market. The first one is rebalancing for the long run. The second is tax loss harvesting. And the third are Roth conversions. So let's get started. As always, we want to look at asset allocation and balancing risk and return first. So I can't emphasize enough what we looked at last week, and we look at in meetings frequently, is this triangle over to the right that starts at the core of what we do, and that's asset allocation, and then draws down to things like market timing and security selection. We'll reference asset allocation again today many times, but we just want to reinforce that asset allocation determines over 92% of performance variances in portfolios. Also, this in the upper right-hand corner, we want to look at the efficient frontier. This is where we attempt to put folks based on their risk tolerance and time horizon. All along here, if we put you on the efficient frontier in the right spot, someone who's very young is going to be over here. Someone who's a little bit further along in life is going to be down here.
Gene,
Okay.
while we're at a stopping point, there's a question about lenders and competing with smaller loans. Do you want to talk about that now or have Clayton talk about it?
Clayton, sure. Give it a whirl, Clayton.
Sharon, I think I'm unmuted now. Okay.
Yeah.
Yeah, we have. That's actually a great question, Ron. We've definitely seen some lenders. I had actually a client call, or it was today. They sent an email and they said, "Hey, we reached out to our current lender, and they actually discouraged us from refinancing. They told us that Now is not a good time. They were increasing costs on refinancing to discourage people to do it because it was costing them a lot of money. And that is true. There's a big discrepancy right now in how different lenders are handling the environment. Some are trying to write as many loans as they can and use the lower rate environment to try and build their books of business up and increase the amount of loans they have on the books. Others are trying to just hold on to what they have and actually discourage those folks that they have from refinancing into a lower rate and aren't really offering lower rates to them. So what I've typically done when I work through this, both myself and with clients that I'm helping, is I start with my current lender and see what they can do. Oftentimes they're the easiest to refinance with if their rates and costs are reasonable. And then from there, shop it with a couple other folks. I personally went to my credit union, and then we went to a local bank here, Synovus. And so we had those three options on the table, and we're able to kind of pick between the three of them. And I think that strategy worked really well when shopping the market. So, but there is certainly a discrepancy, and so would encourage you not just to stop with the first quote or feedback you get, especially in today's market.
Thanks, Clayton. Good job. So our first strategy, which is up on your screen, hopefully, is rebalancing for the long run. We've referenced rebalancing. You've probably seen it in the news, but this encourages the purchase of devalued assets at a discount and sales of appreciated assets at a premium. It adjusts your asset allocation back to the target. So everyone has a target asset allocation, and likely your asset allocation to stocks has decreased since we've seen the market decrease by such a large amount. This is not timing the market. This is being disciplined and going back and reallocating what you should have in stocks. And as you see on point number 3, this is based on your risk tolerance and time horizon before the downturn. Because what our risk tolerance is today or a week ago when the Dow's down 30% may have been different than what it was when we were hitting all-time highs 2 months ago. So we want to keep that perspective on risk tolerance and time horizon and rebalance back to your target allocation. Effectively, by doing that, as I said when we started, you'll be buying discounted assets and selling assets at a premium. Over time, that will reduce volatility and enhance performance. And we just want to be disciplined about that. And we're not quite there yet, but as soon as we see some stability, we will begin to rebalance. A really important fact about rebalancing is you have to continue monitoring the tax effect even now. So if we sold bond funds or bonds at a premium or at a gain, we would be locking in some gains on the bonds while we went and purchased stocks. That's the least of our problems right now. We certainly want to pay attention to the tax effect, but we don't want to let the tax tail wag the financial dog. So rebalancing is incredibly important and something that we've always done, as you know, from working with us. All right, Clayton, I'm going to turn it over to you to touch on tax loss harvesting.
All right. Thank you, Gene. When we're going into rebalance, and this is kind of a great follow-up from Gene's rebalancing discussion, one of the things that we'll be looking at is, as Gene mentioned, the tax consequences of the rebalance. Gene will talk about in a second a strategy with Roth conversions, and he'll go into detail on how that impacts your retirement accounts. But this strategy called tax loss harvesting is actually what we do in taxable accounts. So if you have in your portfolio, some of you may have taxable accounts, some of you may not have taxable accounts. But if you do, when we go into those specific taxable accounts, which oftentimes you'll see on your statements labeled as a joint account, maybe an individual account, or even a trust account. So if you have those types of accounts in your portfolio, when we go in there, we're looking to just make sure we're aware of the tax consequences. And the reason for that is on your tax return every year, this account or these types of accounts that are considered taxable accounts, they're the ones that kick off what's called capital gains. So when you get the 1099 from Schwab at the end of the year, and it says you realized $20,000 of capital gains, well, that $20,000 capital gain goes on your tax return in that year. And so we have the ability to be a little strategic with how we handle those gains and right now losses to help offset the impact on your tax return. So the big benefit to our clients as we go in and do this is this actually will lower your capital gain taxes during the year. So the way we do this is we'll look in the taxable accounts, and if we have positions that have a loss, you actually may see us sell that position. We might actually go in and realize that loss or harvest the loss, as we call it, because what that allows us to do is as we move forward and we have gains, we can use that loss to offset the gains on your tax return. So if we harvest $20,000 of losses through this process, and then we move forward in 2020 or even in 2021, and we have $20,000 of gains in the future, well, it's a wash from a tax perspective. We can use the losses that we harvested to offset the gains, and your tax situation is greatly improved. So, this is something that's really, in the weeds, and it's something we get excited about when it happens. I know, losses and seeing red on statements is not exciting, but from a tax standpoint, we can actually improve your situation. And that's what we'll be doing during this period as we see these opportunities.
Terrific, Clayton. Well done. Tax loss harvesting. The third strategy are Roth conversions. And so we've spoken with some of you about Roth conversions in the past. The benefit of a Roth conversion is it moves investments out of a tax-deferred account to a tax-free account at a discount currently. So a tax-deferred account would be a 401k or an IRA. A Roth is a tax-free account. Tax-deferred means at some point you're going to pay the tax on the value of that account. Tax-free means any growth in that account is going to grow tax-free. The other benefit to this is Roths can provide income tax-free inheritance to heirs. With some changes in the recent laws regarding the Secure Act, required minimum distributions or RMDs are limited. And right now, at least conversions are 30% cheaper than they were just a month ago. Some areas such as energy are even cheaper than that. So I use the term cheaper because you do have to pay income tax on the amount that's converted in the current year. So by way of example, if there's a $100,000 conversion from a traditional IRA to a Roth IRA, if you did that, let's say 2 months ago, or thought about it 2 months ago, that $100,000 IRA is probably worth $65,000 or $70,000 now if it was in a 100% equity portfolio. So you can see the tax on that 70 or 65% is a lot lower than what it would have been just 2 or 3 months ago when the account was worth $100,000. So I'm going to show you a slide that I think helps with this, and it makes a couple of assumptions that I'll comment on here in just a second. So in the top part of the slide, if you're on the left side, if you're currently in a high marginal rate, you're in your working years, and you think your future marginal rate on the right-hand side might be lower in retirement, then it probably wouldn't make sense to do a Roth conversion. Down below, if your current marginal rate is low and it's either going to stay low or continue to be low, as opposed to perhaps raise, then it makes sense to do a Roth conversion. So why would your rate raise if you were currently in a fairly low position? Well, one thing that struck me yesterday was when they passed this $2 trillion stimulus bill, I wondered to myself, how is that going to be paid back? I suspect that's probably going to be paid back at some point in the future by higher tax rates. So we need to keep an eye on that. But also historically right now, tax rates are at one of their all-time lows. So if you're retired, recently retired, having an off year income-wise, it may make sense to look at a Roth conversion. If you're in your high earning years, it may not make sense. This is a decision that's going to be different for everybody, depending on their particular circumstances, but one that we think makes an awful lot of sense for a whole lot of folks based on what's happening now. We got a question a while back, and certainly we'll take all questions now, and Sharon will be our referee. But we had a question about, considering today's market, how would you would redraw, if at all, the risk and return plot? And I think the question was related to our efficient frontier right here. So the question is, what we want to do is maximize the return based on the risk that we have. So from an immediate perspective, it wouldn't change. We want to be on a point where we're taking as much risk as we possibly can, but if we take a lot of risk, we certainly want to get a return. So inherent in the risk right now would be, stocks are down. Are they down for the long term? One of the questions is, has the market priced in what we think is going to be a downturn in the economy over the next 2, 3, 4, 5, 6 months? That's really the $64,000 question. I hope I answered that question. If I didn't, please let Sharon know. I'm happy to elaborate on that and anything else. Okay. Sharon, we got a question. So I'm going to let you take that. Bear with us, y'all. We're still
Okay, Jean, sorry, I'm not seeing another question.
okay. Russell raised his hand.
Oh, okay. Let me unmute your mic, Russell. Okay, Russell, go ahead.
Sharon, can you repeat the question, as I can't hear it? Then I'll be glad to take it.
Yeah, I can't hear it either, Jean.
Okay.
Russell, if you can hear us, can you ask your question? I'm sorry, I think we're having technical difficulties.
Let's see. I'm getting a little bit more intel. I guess you would add range bars around the risk and return. Yes, Russell, you would. It's not an exact science, but it's more of being sure you're not reaching for too much return by taking too much risk, or reaching for too much risk and not getting the return. I hope that helps. And if I haven't done a good job, Russell, you're welcome to email me. I see another question popped up. Would now be a good time to look and rebalance your 401ks as well? Absolutely, it would. And I know the person's situation who's asking this question, they're very young. This is a great opportunity for young folks who have a long time horizon for investments to put the pedal to the metal. And at your age, Michael, you ought to be very, very aggressive, because this is money you're not going to touch for 35 or 40 years. So a blip on the screen, which we all think this is, we just don't know how long that blip will last, will not do anything but help you in the long run. I hope that helps. I know there have to be more questions out there. And we've got plenty of time, everybody. We're in no hurry. There's a great question here about the current market affecting the bond market. That's a very good question. So whenever we have turbulence in the stock market, you've probably heard the phrase flight to safety or flight to quality. Typically that has meant buying US Treasury bonds. And when there's a lot of folks trying to buy US Treasury bonds, the interest rate drops because it does not have to be as competitive. Also, typically gold is a haven for times like this as well. What's interesting is initially US bond rates dropped to about 0.5% on the 10-year Treasury, which is unbelievably low. It means you'd make $5 on a $1,000 bond over the next 10 years when you got your $1,000 back. Those have since come up, which is somewhat contrary, but will probably mitigate a little bit now that the Fed has put some liquidity into the market. But typically, bonds become very, very valuable because that's a safe haven for assets, gold as well. But what we found recently is cash is really where everybody wants to go, hence the liquidity issue that Congress has attempted to quell with their stimulus package. There's still some details to come out about the stimulus package, and we will certainly be sending out information to folks. I gather from your comments, you think the market will stay low for several more months. Well, if I knew exactly, I wouldn't be here. I'd probably be on a boat somewhere. But when we have a drop like this, this is a best guess. It's almost a self-fulfilling prophecy. There's so many folks losing their job in airlines and restaurants, in entertainment, because we're all having to self-quarantine, and it doesn't look like that's going to slow down. Well, when people aren't spending money, as we've talked about previously, that's 70% of the gross domestic product for our economy. So when people close their doors and stay in, they're not spending money, which reverberates through the whole economy. So we're not going to see, in my opinion, an increase in the markets like we saw a decrease in the markets. I think we'll certainly come back to where we were, but it's going to take a little while. I see we've got a couple of other questions here. Student loans affected by the downturn cheaper. That's a person who has somebody in college. I would think that they are. I have not looked at student loans. I think what's really interesting is how are colleges going to handle this tuition issue, not necessarily for this semester, that's a done deal, but for the summer and moving forward. That'll be really interesting. But I don't know, but I'll get you some information on student loans. Another question, should I decrease how much I put in 403B and 457 for now, or keep investing the same amount because I will benefit when the market picks back up? Excellent question. Yes, there's a big sale sign out right now on the equity portion that you're investing in your portfolio. And I know you're probably aggressive where you are. So yes, do not decrease what you're putting in to your retirement plan because you're buying more shares at a much cheaper price now than you were 2 months ago. There's a caveat there. Don't make yourself go poor or reduce your cash balances, i.e. an emergency fund for unforeseen things moving forward. But yes, the sale sign is out for equities. So don't decrease what you're investing in your 403 or 401ks. Okay, what are your thoughts on buying American oil stocks with current issues going on with Russia and Saudi Arabia? As you know, they are very low, and are they a good buy? Y'all have great questions. We have some of the smartest prospects and clients in the world. Yes, we think long-term energy, despite the shale and fracking, is underpriced, severely underpriced. Eventually, Saudi Arabia and Russia, and to a lesser extent, the United States, will get their act together, and we see those moving up. We just don't know when. A couple of the things we've been looking really closely at are the dividends. Are they safe on stocks such as Chevron and ExxonMobil? And I just read an article today, I'm reading a lot these days, where the CEO of Chevron said their balance sheet is strong enough that he said, we will continue with the dividend. So if they continue with the dividend, we saw a little spike up in energy prices today. That's a 9.5% yield. We like that. Yes, we like energy. So you're likely to see us make some buys there in the not too distant future. Next question, are new laws regarding small business loans reasonable if cash flow is an issue, and are they worth pursuing? Another great question, one that I've got to familiarize myself more on the stimulus bill. Whenever there are loans available now, which the money's flowing freely, there's usually a catch. But we'll try to determine what those catches are for you and send you something. If Clayton or Sharon have any thoughts on that, please chime in and I'll give you an opportunity to do so.
Yeah, hey, Ron, just a few comments on that. Georgia has already declared, this a disaster, which opens up the small business disaster relief loans. The rates right now for the Georgia loans are around 3.75% from an interest rate standpoint. So, it's fairly cheap money, and I definitely think it's worth looking at, especially as any small business might need some additional cash flow. This new, they're talking about as part of the stimulus package, a new funding, I guess, department or some kind of new funding group that would be in addition to the small business loan funding oversight. And I'm not really sure how that's going to look, what rates would be like that, what rates will look like from that group. But I think it's, as Gene mentioned, it's something we'll keep an eye on, and certainly we'll be ready to help folks compare and contrast and look at options as these, come out and more details are available in the next few weeks and months.
Nice,
But I
Clayton.
saw some information today that said you should be pulling your documents together for the small business loans. So that would be a proactive way so that when everything opens up, you'll be ready. So you might want to think about that.
Good information. Another question, are you adjusting our accounts with the change in the oil fuel market? Our view has been, let's see some stability in the markets before we make any massive changes. Tomorrow's going to, as I mentioned, tomorrow's going to be a big day to see how the market reacts to what is likely to be massive unemployment numbers. I suspect that it's probably been factored in at some point along the way. And at the risk of repeating myself, that's the big question, is what has the market factored in from a cash flow standpoint and from an earnings standpoint so far? Nobody really knows. But we want to see some stability in the market. We can't time it, but with such an unusual circumstance, once we see some stability, and we've seen a couple of days of it here, we're more likely to begin what we would call nibbling at various pockets of value, which would certainly include oil and fuel. Next question. Assuming that the $2 trillion may not be the only stimulus, what is our view on how this hypothetical might affect portfolio management as well? Very good question. Liquidity is going to be good for the market. Liquidity is going to give certainty to the market. At some point, so that's a good thing. At some point, we're going to have to pay that back, and the market's going to eventually realize that. So we'll pay attention to it. We think certainly liquidity needs to be injected into the market, but we don't want to mortgage the future when pertinent and good decisions can be made today. Question 2, would you have an estimate on how this market will push out the average worker having to work longer? That depends. That's a great question. And for everybody, it's different. So it may push some folks out. There's so many variables there. Is the situation where you could buckle your belt and tighten up a little bit and reduce spending? That could certainly change. We'll recover from this downturn in the equity markets at some point. How quick that is would certainly determine how long you may have to work. And then your initial asset allocation, if you were close to retirement, you likely did not have a large allocation to equities, certainly wouldn't have 100%, so you wouldn't have been hurt. So you would have some money that you could put your hands on. There's a third question there too. With the focus on propping up small business, what is AP's take on investing for the upside in small cap growth opportunities? Wow, we got smart clients. Great question. Small cap, if you think the large cap market has been volatile, i.e. the Dow Jones Industrial Average, small cap has just been crazy. And historically, small cap is crazy and much more volatile, that's a better way to say it, because they're smaller companies, the balance sheets are not as strong. So there'll be some opportunity in small cap, but it will be a more volatile recovery than, say, large cap, oil and gas, some of the medicines, the pharmaceuticals and so forth. So there'll be opportunities there, but that's going to be a real seesaw recovery moving forward. What are our office hours going forward? We are here virtually. We're here via phone. We have discontinued meetings for the protection of clients and for our protection, but we're here. We really want you to engage us. Hopefully today has been a great way to engage us. We plan on doing this on a weekly basis until everybody has some confidence. We hope it shows some leadership. One of the things we would like to know is, what are the topics you want us to talk about? This is a great forum. I'm not great at this, but I'm certainly better than I was last week, which isn't saying much. But this is a great way for us to interact with clients and future clients and folks that just need some information and some intel. So please send us things you'd like to see us talk about. We'll talk about the same thing over and over again if it helps you feel better about what's going on. But we're available. Email, phone. Some of you have my cell phone number, and some of the other folks, feel free to contact us. This is a difficult time, and we want to be here for you, and we think we're going down the right path. Excuse me, I did get a question, I think, on my cell phone, so let me check that out. Oh, just a client trying to be funny. Levity and humor always helps at these times. Well, I may as well tell y'all, it was a client asking if his wife should go back to work. I'm not even going to entertain that question. My wife is on this call. Sharon, how are we doing on questions?
I think we are current on questions.
Okay.
I don't see any other raised hands or questions.
We'll give it another minute or two for anybody who's shy. And while we're waiting, again, pay attention to what is going on tomorrow, but moving forward. There's a lot of data out there. One of our jobs, we hope, is to give you good data. We don't know what tomorrow holds. We don't know what next month holds. We don't know what the next year holds. But we do know what historical asset classes have done. And we hope that you feel better as a result of what we're talking about now. So thank you. Be safe. Engage us. We're grateful for the confidence that you placed in us. As I said when we began, we've got a terrific team. I'm very proud of them. I'm happy to work with them. I think you should be proud of them too. And we're here to help you in any way that we can. Be safe and wash your hands.